for a new pair of shoes. You enter the store and you take a look around and you pick up one of the first pairs you see. You try it on, walk around a few steps, and for the most part, you like them. But something's off. Maybe they fit too narrow, and as a result, they're feeling a little bit tight. So you tell yourself, they'll stretch out over time, but who's really to say for sure? You see, purchasing a new pair of shoes is much like entering a new market, whereby achieving excellence is a result of long-term success and not short-term. And Mr. Brandt, this is exactly what your company is facing today. As a company looking to enter the Japanese market, you need to ensure that long-term success is at the forefront. And this is because your firm is deeply rooted in an organizational philosophy of long-term success over short-term results. My name is Ali, and today I'm here with my colleagues, Ali and Jerry, to help guide your evaluation of entering this Japanese market. Today, our presentation will consist of an overview of the entire situation, followed by an in-depth analysis, including the different alternatives that you have. Following this, we will discuss our recommendation, followed by an implementation and a discussion of the possible risks to what we are recommending today. So the question is, how should Orbis enter the Japanese market? Based on the issues that we have identified and the key considerations we have taken into account, we are recommending that you enter the Japanese market contingent on finding a firm that is better aligned than Target Securities Co.
So, before jumping into the nitty-gritty details of this venture, we're first going to take a step back and look at what are the real external conditions of this Japan market and what makes it so attractive for Orbis. So one of the first things that we notice is that the Japanese market, after a couple of years of stagnation, is now starting to grow again at an alarming pace. And this is furthered by the introduction of the NISA policy. So this NISA policy allows for the tax exemption of the capital gains from investing in mostly long to medium-term investments. And this really resulted in a higher demand in the Japanese market, especially in the retail investing sector, for moving in and making these investments long-term. And finally, the third thing that we know is that a lot of the asset management companies in Japan over the last 5 years have significantly increased their operating margins from around 8 to 9% to about 30%, showing that the industry is at a prime time to enter and make significant profits. So when we take a peek behind the curtain and see what's really driving this attractiveness of this industry, one of the first things that we notice is the population demographics. And that is that a significant amount of the population is centered around the 25 to 65-year-olds. This means that about almost 40% of the population is in the prime years for investing. Now, I really have to commend the Japanese government for understanding this and putting in place the NISA policy to motivate these large group of individuals to make these long-term investments and secure their future retirement savings. And I really have to, in addition to that, commend Orbis for realizing this as well and seeing that this dynamic and this industry is really a perfect opportunity which aligns with Orbis's strategy. So quantifying what this market really looks like, in about 2014, it was about 1.5 trillion Japanese yen in retail investing, which is approximately 3.6 billion Canadian dollars, when factoring in the 22% is managed by asset managers. But this was the 2014 numbers. 2015 early is when the NISA policy was implemented, and this number is expected to grow rapidly. And so far what we've seen is 2015 is confirmation of this growth. So, a key consideration of the Japanese market when compared to some of the other markets that Orbis is already in, for example, Canada, is to see that the price to earnings for Canada on the left and the S&P 500, the North American markets, compared with the Japanese markets on the right, is that the companies in Japan trade at a significant discount. And this is a perfect opportunity to enter the market. It means acquisitions will be cheaper, and this means that Orbis can take advantage of this compared with the other locations. Now, when we look in how Orbis can specifically benefit, what kind of resources are in Orbis's arsenal to take advantage of this, the key thing to note is that long contrarian investing, long-term focus of Orbis' strategy in mainly publicly traded global stocks. And this is actually perfectly aligned with the demand in the Japanese markets, with the government policies that Japan is implementing, showing that there's a real demand for these long-term stocks as this middle population ages towards retirement. So Orbis' strategy is perfectly aligned with the opportunity in Japan. Now, what makes Orbis' strategy really tick though, what makes it really work, is that every aspect of the strategy is perfectly aligned to support this long-term growth, from your employees, to your incentive structure, to even the ownership of the company. Throughout the organization, the alignment is perfect and absolute, and this is one of the key things that we're going to consider when looking at what is a viable strategy to pursue this venture. Now, in addition to looking at this alignment of the strategy, there are a couple other things to note, a couple other important factors to consider, which are financial feasibility, whether the acquisition will work, whether it's financial, or whether the startup can work in terms of finances. Whether entering the Japanese market, you will have the experience needed. You'll have the inside knowledge to obtain the licenses that are required. This is a pretty significant detail, and this is very important in the analysis, because legally, Orbis cannot enter this industry without securing these licenses for asset management. Now, finally, I want to draw your attention to the fact that we want the strategy to have a minimal amount of culture clash. This is significantly important. Expanding into a Japanese market, an Asian culture, is significantly different from North American culture and from a lot of the other locations that Orbis has already expanded towards. And one area that we really want to focus on is that the alignment of this strategy, which ensures the key success of Orbis, works because every part is aligned. Even if one little portion of that strategy goes off, if there's a culture clash, if the employees don't work, everything cascades and it falls apart. So making sure that the strategy we recommend ensures that the culture of Japan works is a key consideration we're going to consider. Now that we've seen that Japan is a perfect and ripe and ample opportunity, there's essentially two ways Orbis can go by and enter this market. One is to go greenfield, make your own startup, and just go Orbis. The other is to acquire an existing company that's already in this Japanese market. So we'll start our analysis by looking at the implications of first what a startup will look like, whether this is feasible, and then we'll go more in depth and see how this compares to an acquisition. Now, in evaluating whether a startup will work, looking at some of the financial implications, the initial cost is about 1.2 million as communicated to us by Orbis. A lot of this is in legal fees as well as the initial capital required to enter the market. Now, we assume that Orbis will capture about 0.1% of the market, which we believe is fairly reasonable, considering there's about 250 players already in the market. And for an outside company to come into a Japanese market, it should be fairly difficult to achieve this market share. And being a small company, it will achieve a growth rate of about 5%. And we've considered about a 20% WACC. Now, arriving at this number, we looked at some comparable companies in Japan, used their betas, and using the CAPM method, we arrived at about a 15% WACC. And then to add on an additional premium for the specific risk into Japan, we add another about 5% to the WACC. And what this looks like is that there's about 1.5 million in net present value in entering the Japanese market. On first glance, this may seem like a startup is a great opportunity, but once we consider some of the more qualitative factors, this number can be a little bit deceiving. So the key thing to note is that the Japanese experience is key. You cannot operate this business without having the licenses in place, and going in Orbis without making an acquisition, Orbis will have to contract Japanese partners that are already in the business. They'll have to hire themselves, and in this way achieve the licenses that are required to compete in this industry. Also, another key consideration is that for an outside company, a North American, European company, to come into the Japanese market, and take away some market share from the Japanese companies, this might create a bit of a clash. And it's a very risky venture, considering that this is a fairly new market for Orbis. So when we consider these these considerations, we assume that this will make the project a lot more risky entering the Japanese market, and we quantify this by saying that the WACC may be significantly higher than what we have said. Perhaps it'll be 30%, 35%. This is actually very typical for a new startup company, especially one in a market that you're entering that has never been entered before by the company. So at around a 35% WACC, the NPV actually drops to 0. The riskiness of startup is significant, and this means that there's perhaps some other options that should be looked into in expanding to Japan.
Great. So as Ali mentioned, the opportunity of pursuing a startup is not attractive in the Japanese market. The other option we do want to look at is acquiring a company who already operates in the Japanese market that we can leverage their expertise. One target we did look at was Target Co. And we performed a variety of analysis upon that company to see if it would be the right fit as well as the right financial metrics for Orbis. As you can see on this slide, looking at the comparable companies and using valuation metrics of price to earnings as well as price to book, which are the two main valuation ratios for financial services as well as banking companies, we arrive at a valuation of approximately 1 billion to 16 billion yen, which translates to about 10 million to 160 million Canadian dollars. As you can see, this is a very wide valuation range, and we'll refine it further as we go along. But for a point of reference, the market cap of the company in question is approximately 130 million Canadian dollars. The next analysis we did look at was a discounted cash flow analysis. And in order to get cash flows, we use some metrics in order to derive that. So this would be the Japanese share price of $230 divided by the price to cash flow multiple, which got us a cash flow per share of $9. And this is the number we use in our discounted cash flow analysis. So using that, we arrived at trailing 12-month cash flow, approximately 500 million Japanese yen in cash flow. And we used a WACC of approximately 15%, as well as a growth rate of 3%. So using all of these numbers, we got an implied enterprise value of approximately 40 million Canadian dollars. So comparing this to the market cap of approximately $130 million and a wide valuation range of $10 to $160 million, we see that the market cap seems to be on the high end or even very high end of what the fair value of this company should be. And in addition, there are a variety of other factors about this company as well that makes it not an attractive investment for Orbis. And again, this is just to show the sensitivity of our valuation to different inputs such as WACC as well as growth rates. So based on this valuation, you can see that the effective range is approximately 38 to 44 million Canadian dollars. Again, so this valuation is fairly stable given different assumptions, and we can be fairly certain that the company is not necessarily worth the 130 million market cap that it currently trades at. So what we see is that the investment in Target Co. does not meet the financial feasibility, and it doesn't meet the alignment of strategy. And I'll mention a bit more on this alignment. The current company operates primarily in securities trading as well as underwriting services. And so in order to buy this company, we would need to sell off the ancillary businesses to keep the core mutual fund sale business. And given that M&A transaction fees are in the range of 6 to 8%, we would effectively be giving up almost $10 million in fees in order to sell off the majority of the business, again, both ways. So that adds up to about 15% in fees that we would be giving up. And finally, to conclude this portion is that this company is not trading at an attractive financial metrics and does not fit our strategy going forward.
So just to summarize what some of the alternatives look like, we talked about how the startup does not provide the Japanese experience that's absolutely critical to entering this industry, and as well as it instigates some cultural clash. Now, in looking at the status quo, we see that this doesn't take opportunities in the Japanese market, which is why we reject it. And finally, that the only way possible to enter this market and actually achieve this economic benefit is to acquire a company moving forward.
So what are we recommending today? You want to enter the Japanese market, and we're recommending that you need to find a firm that's better aligned than TargetCo to do this. So how are we going to achieve this together? We recommend a 3-phase implementation plan. The first of which is due diligence, followed by acquisition, and then finally integration and alignment. And both of them, or all three of them rather, are rather time sensitive. So due diligence will be the first phase, acquisition will be a little longer term, and finally integration and alignment, a very long term outlook on this recommendation. Diving right into it, due diligence. The first immediate action that Orbis can take is identifying potential targets. So these targets should have business lines that are better aligned to what Orbis is looking for in expanding Orbis access to the Japanese market. So one in which the firm already operates in dealing with retail investing would be one. Also that it has the clientele that we are searching for to take on this retail investing arm. Secondary is establishing local contacts. So in entering this new market, because of the importance that we stressed of dealing with regulators and getting this licensing, it's important to establish these contacts before you actually even enter the Japanese market itself. So finding contacts on the ground there who are familiar with how the regulations work, may already have existing relationships with people in the JSDA, will be another immediate action that you should take. Following this, once you're able to identify that potential target and establish those local contacts, it'll be important to initiate communication with the JSDA itself. Given that you have this big plan to enter into the Japanese market, it's important to be on the same page with the people that could either decide whether or not you can enter that market itself. So those first two immediate actions, followed by this delayed action of establishing communication, will ensure that the entry into the Japanese market will be as easy as possible. Phase 2 is acquisition. In order to acquire this firm that you will be targeting, you will need to source debt financing for the acquisition itself. The possibility of a small bridge loan or another form of short-term financing can help achieve this. Following this, communicating these acquisition plans with the target firm itself will be important for a number of reasons. Not only will you have to communicate where you would like to see the firm go, but also involving the key players within that company on where the company is going to go moving forward. And that leads on to the third part of acquisition, which is ensuring that these key employees are retained. As per Japanese culture, it'll be important to involve everyone in the process of this acquisition. Just walking in as Orbis and saying that the Orbis employees will tell the Japanese employees what to do or design the strategy of the firm going forward will not be as effective as including those key players in where the company will be going forward. Finally, phase 3 is integration and alignment, and by far one of the most important phases of our recommendation. In order to transform the culture of this new firm to what Orbis values in terms of its organizational philosophy, it'll be important to initiate programs such as training and mentorship programs whereby these new employees are able to understand and align better with Orbis's culture on a going forward basis. Secondly, evaluating the differences in compliance and operating procedures between the two companies, Orbis and this new target firm, and as well between the operating that we've seen in the 9 countries that Orbis already operates in versus this new Japanese market. And finally, establishing ongoing monitoring of this company. Because we will be you will be transforming the culture of this company, you need to ensure that on an ongoing basis you are achieving the culture as well as the success going forward. We have identified 3 risks, and because we have also identified mitigations for this, we would be happy to discuss this in the Q&A period. So in conclusion, we came here telling you that entering the Japanese market is going to be a lot like buying a new pair of shoes. Now what does that mean? It means that they need to work not only today, but they need to work on an ongoing basis. So as Orbis looks to move into the Japanese market based on the issues of market viability, feasibility of this recommendation, and this cultural alignment, we need to ensure that you are able to achieve excellence going forward, long term. So when you buy a pair of shoes, you want to make sure that you're not going to have blisters going forward, and we want to make sure that Orbis is able to achieve success as it moves into the Japanese market. Thank you for listening, and we open the floor to any questions you may have.
timeline for your implementation?
So for the first phase, so due diligence is really going to determine how the entire timeline is going to play out. This all depends on how long it'll take to find that potential target firm. So this could take anywhere from 6 to 12 months perhaps, depending on how long it takes to find that firm that's best aligned to what you're looking for and your culture as well. Following this, once acquisition and integration and alignment get into play, now we're thinking about very long term, so at least a year to 2 years by the time the alignment occurs. And obviously this is something that at least we think that Orbis will not be afraid to take on because of the focus on this long-term success rather than the short-term success that may or may not play out, at least within the first 2 phases of this acquisition itself.
Right. So Target Co is obviously kind of a bombed-out company, but they don't have lines that are very interested in getting visa. So do you just have a lot of difficulty finding a target that has more attractive lines of business? Obviously, those businesses all be very well bid, and we'll probably have to pay very expandable to pick that up. What the risk associated with that?
So the key component of this market is that there's a fairly large amount of players, about 250, and we anticipate that considering against the competitors in the Japanese market, the multiples may be more if they are aligned to take advantage of NISA. But one of the key considerations was that the Japanese market itself is trading at a fair discount to some of the other markets such as Canada, Europe, and North America. And for this reason, moving into the Japanese market, even though the specific company that aligns may be at a higher premium, but compared with other opportunities around the world, it's still a discount with some of the other possible acquisitions.
And on what you just said there, don't you feel there's quite a risk if you wait that valuations in Japan will become more similar to other parts of the world? I mean, it appears to be cheap right now. Why not move right now and get the license and get chatting about that?
Yeah, exactly. So, as we mentioned, the key success of Orbis is this alignment throughout every part of its value chain. And this is really what drives the success of Orbis. Now, in jumping into the market, it is important to get in as quickly as we can. But on the same time, we don't want to jump in and buy shoes that will just give you blisters and just cost you in the long run. So it's important to have this alignment and pick the right partner. So we do recommend right away starting the due diligence, making progress to find the right companies, but not settling for something that will hurt Orbis rather than help Orbis.
In the beginning of your presentation here, the net present value for starting up their own firm seems like a lot of a better deal, only $1.5 million. Can you expand on why you don't think we can compete with the Japanese market experience and how we can minimize the culture clash?
Yeah.
So yeah, in order to get Japanese expertise, the local laws require you to have employees that have at least 3 years of prior experience working in the Japanese market. And so in order to get that startup running, we would essentially have to go to Japan to source those employees. So once we're already there, we have already sunk the cost, and we're not sure whether or not we can find those employees. Second, we would have to become licensed. So this would involve having a history of dealings or having assets in the Japanese market. And the third barrier to that is to have brand awareness. So given that the platform we are selling is an online platform, it will be very difficult to have physical presence or for consumers to know about Orbis's online access offerings without an established partner with local clients who trust the brand already. So for those reasons, we believe that the startup option may look good on an MPV basis, but they're very substantial qualitative barriers.
Risk premium that you added to your weighted average cost of capital. Can you just give me your top 2 reasons for adding that risk premium?
Yeah. So we calculated about a 15% weighted average cost of capital based on CAPM with Target Securities Co. Now we noticed that the difference between starting your own venture and going with an established player in the industry that already has contacts is significantly more risky. So we started with about a 5% add-on of that, and then we sensitized that over a significant range, and saw that at about a 35% WAC.